Oh, yeah, I know. Well,
Good morning, everybody. This is Tony Milano with the WCIRB. We're ready to get started with our webinar today. Joining me today on this webinar is Katrina Sonka, one of our actuarial analysts. Today we're going to talk about the third quarter 2018 quarterly experience report. We'll go over some of the results from the third quarter. And then Katrina is going to demo one of our new reports / tools called the Interactive Policy Year Statistics. What that is going to do, show you how to get some data that's available on our website for free for the public to show you how to slice some data in a new interactive tool that we've released recently this year. And also the quarterly experience report is also available on our website in the research section, so you can get the full report there. I'll highlight a few of the key slides in this webinar this morning. If you have any questions during the webinar, please use the questions panel in the webinar app. The phones have been muted on the customer end, so if you have any questions, please type them in and we will respond to you. After the webinar, if you have any questions, please email those to communications@wcirb.com and someone will respond to your question if you thought of one after we finish the webinar today. With that, I'm going to go ahead and get started and start talking about some of the third quarter experience. So the first thing we're looking at here is total written premium. This is gross of deductible credits, so it's the first dollar premium amounts. We're right now in a kind of a downturn in premium. It's been declining for the last couple of years. 2017 was about 2% below 2016 at $17.7 billion. For the first 3 quarters of 2018, we're at $13.1 billion, and that is about 3% below the same period for 2017. So after many years of escalating premiums driven by rate increases, we're now on a downturn, and that's primarily driven by decrease. Okay, sorry about that. We're back. So the latest premium decreases have been driven by decreases in insured charged rates, counteracted by continued improvement in the economy with increased payroll, also driving the premium up a bit. So the rate decreases have more than offset the payroll increases. And this next slide is showing the average charge rate per $100 of payroll. So you can see from 2014 on, we've seen decreases in the average charge rate, some pretty significant decreases over the last couple of years. Through the first 9 months of 2018, the charge rate is $2.28. That's about 10% below the 2017 level and about 23% below the peak in 2014. A lot of the decreases in the average rates have been driven by the recent reforms, greatly reducing average medical costs, and the frequency of claims have been flat to slightly declining, also been driving the rate decreases. On the pure premium rate side, the average advisory pure premium rates that the WCIRB proposes and the insurance commissioner approves, those are down about 42% from January 1, 2015. That's the rate level as of 1/1/2019. The insurer rate decreases have mostly mirrored the pure premium rate decreases. They sometimes lag a bit by a couple quarters, so that's why you haven't seen the full effect of the pure premium rate decreases. We expect those to continue to decline to mimic the decreases in the average pure premium rates that the commissioner has approved. Next, we're looking at accident year combined loss and expense ratios. So these are ratios of losses, loss adjustment expenses, and other insurer expenses to premium. So this is the full combined ratio. We've seen pretty flat ratios over the last 4 years or so. 2017 is up a little bit. That's mostly driven by the decreases in the denominator, which is the insurer's charged premium. Losses themselves have been pretty flat. They've increased a little bit. The average severity went up a little bit in 2017, but mostly flat. Mostly the increase is driven by a lower premium amount being charged. And these ratios that we've seen have been the lowest in California since the coming out of the last set of reforms in the early 2000s, where the ratios got to around 60%. Not that low here, but this has been the lowest we've seen for many years, and pretty low compared to the history for California. Okay, next we're looking at claim settlement rates. So we're looking at, this slide is actually showing of all open claims that are in the system, the insured system, what percentage closed during the next year. So this is just a measure of the rate of claim closure. Over the last several years, we've seen a great acceleration in claim closing rates. In fact, the most recent year has shown increases that surpassed even other prior years. So there's no sign of the claim settlement rate slowing down. A lot of these rates have been driven by improvements from the reforms of SB 863, which introduced the independent medical review process, independent bill review, some restrictions on how liens are being filed, also simplification of how PD ratings are computed. A lot of that has caused speed up, particularly in permanent disability claims. They're the ones really driving this figure. Permanent disability claims typically are open longer, but we've seen them closing much quicker. In fact, just one example for very early claims, the closure rate doubled from 2013 to the most recent data. So they've been accelerating very quickly. The next metric we're looking at is indemnity claim frequency. We've seen some interesting things in frequency in California over the last several years. There were some increases in 2010 and 2012. A lot of that was driven by the recession in 2010, driving claim filings up. That was also seen in other states as well. In 2012, the increase was more for California only. Other states had started to show declines by then. The 2012 increase driven a lot by cumulative injury claims and late reported claims. That's an issue that's pretty focused in California. Cumulative trauma claims filings have increased a lot over the last several years. we issued a report earlier this year that kind of looked into some of the drivers of the CT claim reporting and some of the issues surrounding the increases in CT claims. That's also posted on our website. It's called The World of CT Claims. In the more recent years, California claim frequency has been flat to declining a little bit. This is still not typical of the long-term rate of decline, which has been 3 to 4 points. Other states have shown a return to the more steady rate of decline. So the NCCI average frequency rate over their states was about 3 to 6 points of decrease over the last 5 years. So the NCCI measure showing a more deeper decrease in California, though we've stopped seeing increases in the California claim frequency. My next chart is looking at claim severities. So this is looking at total combined severities for losses and loss adjustment expenses. So it includes the indemnity, the medical, and the allocated loss adjustment expense. The total severity, remarkably in California, has been pretty flat over the last several years. This is pretty atypical. We usually see increases absent reforms, and during reform periods, we do see some declines. We did see some declines in the SBA 63 era from about 2010 to around 2014, but since that time, we have not seen a return to the more steady rate of increase. A lot of this is driven by the average medical, so let me skip to that one. So this is looking at the average cost of medical. Now, medical is the primary driver of costs in California workers' compensation. Just disputes over medical also drive up the ALAE. They keeping claims open longer for medical services also drives up the indemnity costs. So medical is really a primary driver of the total rate level in California. You can see following SBA 63, the average cost declined pretty significantly. Usually coming out of reforms, we see some pretty hefty increases for a few years after reforms, and we have not seen that yet in California. 2017 is about 2% up over 2016, which is still a pretty modest growth amount, and again, very atypical from what we've seen in other post-reform years. So kind of digging into the medical costs a little bit more, this is looking at data from our medical transaction data. What we're showing here is just changes in total medical service cost levels. So from starting in 2013, so a lot of the driver of the change in medical costs was not really the average cost of a service, of a transaction, but more driven by which has increased. That's the gray bars, just the average paid per transaction. But it's been really driven by changes in the utilization. So the number of medical service transactions per claim has decreased significantly, about 22% from 2012 to 2016. In 2017 and 18, we've seen that the declines sort of moderate, and overall it's been pretty flat medical costs, and 18 through the first 6 months has also been pretty flat. So that's something we're going to keep an eye on to see if this returns to the more typical rate where on net it increases. So that previous slide was looking at just all medical service cost levels. This next slide is looking at just pharmaceutical costs. Pharmaceuticals has been a very significant driver of the total decrease in medical costs. Pharmaceuticals are typically paid much later on claims, and there was a lot of opioids in California that have gone away, and so that's all reflected in this chart. You can see the very deep declines in the number of transactions per claim for pharmaceuticals. In fact, in total, it's a pretty staggering figure. It's about something like 80% decrease from 2012 to 2018, which again, another significant decrease. Also, the average paid per transaction has also gone down for pharmaceuticals, and particularly in 16 and 17, that was driven by updates to the Medi-Cal fee schedule for pharmaceutical costs, driving the average pay per transaction. So pretty much all signs on pharmaceuticals are showing decreases on all levels. We had another reform that went into effect earlier this year for pharma. It was the new drug formulary that dictated whether some pharmaceuticals are exempt from prospective utilization review or whether they're non-exempt on the formulary. We expected that to have a modest decrease in average pharmaceutical costs. Through the first half of 2018, we see continued significant decreases. Some of that could be the new formulary. Some of that could just be continuation of things we've seen over the last several years, like reduced opioids, reduced physician dispensing of pharmaceuticals, things like that. So it's hard to tell which is which, but in any case, we've seen continued decreases in the pharmaceutical costs in 2018, pretty significant. Okay, my last slide is just going to look at lien filings. Liens are another pretty unique California phenomenon. A lot of other states don't have liens, and definitely not in this sort of volume. We've had several reforms to try to address some of the increases in liens. In fact, the prior to SBA 63 is not even shown on this chart, and that had a significant effect. What this chart is kind of showing is the post-SBA 63 lien. We saw some ramp up in 2015 in the number of lien filings. That was driven by some of the unique provisions of SBA 63 related to the statute of limitations. There was kind of a dual statute in effect for 2015 and 16 through June. But in the third quarter of 2016, we saw the liens decline to about 77,000 liens were filed in the third quarter of 2016. We then got some new reforms. So SB 1160 and AB 1244 had several provisions to address lien filings, such as each lien has to be filed with a declaration under penalty of perjury that the lien satisfies several criteria, and providers couldn't assign a lien to a third party except in special circumstances, and then any provider indicted for fraud has their liens automatically stayed, and then they have a consolidated process to resolve those liens. So those reforms we expected to have some impact on lien filings, and in fact they did. You can see in 2017 and continuing into 18, significant declines in the number of liens filed. In 2017, the lien filings were about 40% below the pre-reform level, but they've actually continued to go down. In fact, 2018, the third quarter is about the lowest we've seen of lien filings in California for a long time. And now the lien filings are about 50% below the pre-reform level. So the lien filings continue to decrease, and a lot of that's driven from the recent reforms of SB 1160 and AB 1244. So that concludes my summary of the third quarter experience. If there's any questions right now, we can take some questions now. Okay, if not, I'm gonna go ahead and turn this over to Katrina, who's going to demo our new interactive policy year stats report. So let me get to that. Okay, so this report is a new report tool that we have posted on our website. It essentially replaces the what we used to call the summary of policy year statistics, which showed various loss and exposure and premium amounts cut by industry and by premium size. However, the report was in a PDF format, so it was very difficult to get data out of it, and also just summarize the data at one level. So if you wanted to get historical data, you'd have to compile several reports in a row. So what we did is we kind of turned that report into a data file so people can get the data easier. And also the historical data is all in there. And we also added a lot of neat features to allow you to slice and dice the data to get whatever flavor that you're really looking for. So I'm going to turn it over to Katrina now, who's going to give you a demo of how the new report works.
Thank you, Tony. The structure of this file is several informational tabs on the left, followed by 3 green tabs on the right, which contain the data itself. Firstly, the Data Elements tab includes definitions and descriptions of all terms that are used within this report. For example, policy year, the year in which a policy incepted, report level, which is essentially a maturity, report level 1 corresponding with 18 months after a policy's inception month, report level 2 being 12 months after that, and so on, as well as a list of the NAICS sector code, which is essentially industry, some more definitions, injury type, and the data types that are used. Moving on, the Instructions tab contains some instructions to fall back on in case you ever get stuck, as well as a thorough example with screenshots. I encourage you to take a walk through this example to get used to this report. Now, the data tabs, firstly, we have losses by injury type. In general, these data tabs are formatted such that the data is housed in these triangular shaped areas, with policy year being along this column, policy year corresponding here, report level being along the top. To the right means more mature policy years. On the left, we see that this data is split by injury types, death, permanent total, and so on. All injury types is a sum of all of the injury types included below. On the upper left, we see a title which describes the data that is being included here. For instance, we see that the NAICS sectors selected, well, all sectors are selected, so statewide data is shown. There's no filter on the status of included claims. Open and closed claims are included, and the data that is being displayed is paid indemnity. Now on the right-hand side, we have the data that we can select, as well as filters that we can implement. For instance, we could change this dynamically to select incurred medical, and here, this section of data is now updated, and thus the title is updated to show that incurred medical is being displayed. Furthermore, we can filter using this. Let's say we want open claims. We can select claim counts and then select open claims. This will now update to show open claims in this data section. And as we can see in the upper left, the status is open, the data being displayed is claim counts. If we want to go back to looking at all claims, that is reported claims regardless of status, we can clear this filter using this button in the upper right. Notice it has a filter icon with a red X. We can clear that filter, and now both are being selected. Furthermore, we can select based on sector, again, which is industry. Let's say we want to look at paid indemnity for all claims in the outside sales sector. We can select this. If we would like to select more sectors, all we need to do is hold down Control, and we can select multiple sectors here. To go back to selecting statewide data, we can clear the filter again here. Moving on, we also have exposure by sector, that is payroll and pure premium in a similar format with the data being shown here by policy year and report level, policy year 2014, report level 2, so on and so forth, as well as historical data. The data being displayed is payroll and currently selecting statewide data. Similarly, we can select some, Control click to select multiple, and then clear the filter to go back to selecting everything.
So the losses is at a claim level, that's why we have it by injury type, and you can get it by sector. Exposure data is reported only at a class level, and so we only have the industry code, and then the next one she'll show is at a policy level. So it's kind of increasing, or I guess decreasing, granularity of data as we go through there.
Thank you, Tony. Finally, experience by premium range, again, is at a policy level. So here we have premiums of any size, which is, moving on, we have final premium policies which have a final premium ranging from $1 up to, but not including, $500, $500 upwards, etc. And at the top, similarly to the losses by injury type tab, this premium of any sizes includes all premiums, all policies of any range of final premium, which is essentially the size of a policy or perhaps the size of a business. Similarly, we can select multiple fields. We can look at this by incurred or paid losses, as well as exposure, payroll, final premium, and this is updated in this data that's being displayed. Now, one thing I'd like to point out is here we filter by dominant NAICS sector, which is a little different from this NAICS sector in that this is at a policy year level. So the dominant sector for a policy is the sector corresponding with the policy's largest amount of payroll, which essentially shows what industry a policy or business belongs to. For example, if we were to select retail, this section of data generally corresponds to paid indemnity for retail policies of a smaller size. So using this tool, we can get a very good feel of what's of the loss experience that's happening in different industries. And perhaps one of the most exciting features is that this data can be copied and pasted to external sources. This will paste as values in an Excel format. So please feel free to use this as you wish. And if you ever need a little advice or need to know how to hit the ground running, please refer to the instructions tab, and that should help you get started. Thank you.
Okay, so yeah, like I said, it's we're very excited about this new tool. There's a lot of, I hope you see it's pretty easy to use, and there's a lot of great data in here. Right now, this is available on our website right now in the research section of the website. I think it's under System Summaries, and also in the research kind of tab in our website, along with the third quarter experience report. So it's all in the same sections. Right now, we can take any questions that we may have from the audience. So we had a question, is there any carrier information in this report? And there's no carrier identifying information. This is a public report with statewide data. So all our public reports are on a statewide level. There's no individual insurer information, and no way to slice by insurer segments, due to privacy reasons. So there's a couple questions on how to get to the report. So we have a little time, so we can just show you on how to get to it through our website real quick. But first, there was another question about how the NAICS sectors are determined. So for the loss, This is based on the class code reported on the claim, assigned to a sector based on a mapping that we've developed. So that it's the class code directly from the claim assigned to a sector. On the exposure side, this is not the dominant sector. On the exposure tab, this is still the class code with the payroll amount assigned to a sector. So each policy might have several class codes. Each of the payroll amounts on those class codes may be assigned to a different sector on the policy. Just kind of depends on the type of policy. On the premium range exhibit, these are the dominant ones. This is where the entire policy total is assigned to a single sector. As Katrina mentioned, it's based on the NAICS sector with the most payroll. So for example, if one policy had half its, about 60% of its payroll in the health industry and about 40% in the hospitality industry, all the information on the policy would be assigned to the health industry for this exhibit. On this exhibit, it would be 60% in the health and 40% in the hospitality. So it would be as it's reported on the policy, as opposed to this one where we assign a single sector to each policy. So now I'm going to just kind of quickly show how we get to our the report on our website. Let's go WCIRB. Okay, so this is just our homepage, and then if you go to the research section, under System Summaries is where this one is, and then it's under Policy or Statistics right here, and then this is the report. It would download it on your machine if you clicked here, and we're going to continue to update this. Basically, the idea with this report is to no longer issue separate reports each year. But since this is just a tool with data, we'll be updating the data each year to add a new year and then add a new maturity level for each of the historical years, so that essentially it's the same report, the same link maybe, where we're just adding information as we get the next year of data to this report. Okay, I'm not seeing any more questions right now. Of course, if you have any questions at any time, you can email us at communications@wcirb.com, and we'll definitely get back to you. And I think this is our last webinar for the year, or was at least my last webinar for the year, but I believe it's our WCIRB's last research forum webinar for the year. And so thank you for those who attended a number of these webinars over the course of 2018. We have more in store for you in 2019, and we'll see you in 2019. So have a good holiday, everybody.
Thank you.